Independent directors are entrusted, above all else, with safeguarding shareholder interests. This is a paramount duty, a cornerstone of corporate governance, and ensuring sound corporate governance. Their role is pivotal in maintaining ethical standards and responsible management. At the core of this responsibility is financial oversight. It's the bedrock upon which informed decisions are made. Without financial literacy, a director cannot effectively challenge management, contribute meaningfully to discussions, or guide strategy with confidence. Financial literacy is more than reading numbers. It's not just about balance sheets and income statements. It's about interpreting the company's story, understanding the underlying trends, identifying potential risks, and seizing emerging opportunities through its financials. History shows that board-level financial ignorance, a lack of understanding at the highest levels, can lead to catastrophic failures, resulting in significant losses for shareholders and stakeholders alike. Warning signs are often visible in the statements, subtle clues that can indicate trouble, but only to those who understand them and know what to look for. Directors must scrutinize budgets with a critical eye, rigorously assess risk, and ensure transparent reporting to maintain trust and accountability. To protect against fraud and mismanagement, safeguarding the company's assets and reputation. Legal frameworks like India's Companies Act provide a structure for corporate governance, hold directors personally accountable for financial misstatements, emphasizing the importance of due diligence and informed decision-making. Ignorance is no defense, highlighting the critical need for directors to possess a strong understanding of financial principles. Financially literate directors engage meaningfully with auditors, asking probing questions and challenging assumptions, and ensure the audit committee functions as an effective watchdog, providing independent oversight of the company's financial reporting. Ultimately, financial acumen empowers directors, giving them the knowledge and confidence to make sound judgments, to shape sustainable strategy, ensuring the company's long-term viability and success, and act as true stewards of long-term value, protecting the interests of all stakeholders and building a legacy of responsible leadership. In short, financial literacy transforms a director, elevating their capabilities and enhancing their effectiveness. From a passive observer, someone who simply attends meetings, into an active guardian of the company's future, a proactive leader who shapes the organization's destiny. The balance sheet offers a snapshot of a company's financial position at a specific moment, what it owns, what it owes, and the owner's stake. Governed by the equation assets, liabilities, plus shareholders' equity, it reveals how resources are financed. Assets are listed by liquidity, current assets like cash and receivables, and non-current assets like property and patents. Liabilities are split into current, due within a year, and non-current, long-term debt. Shareholders' equity shows the owner's residual interest after debts. For directors, the balance sheet is a diagnostic tool. High receivables may signal collection issues, mismatched debt, and assets can flag liquidity risks. A growing retained earnings figure signals sustained profitability and prudent management. Analyzing the balance sheet helps directors assess financial stability, capital structure, and risk. It's the foundation for informed oversight and strategic decision-making. The profit and loss statement, or income statement, tracks a company's revenues and expenses over time, revealing profit or loss. It starts with revenue, subtracts the cost of goods sold to show gross profit, then deducts operating expenses to arrive at operating income. Directors should monitor gross and operating margins for signs of efficiency or trouble. The bottom line, net income, shows what's available for dividends or reinvestment. Scrutinizing each line helps directors understand the true drivers of profitability and spot inefficiencies. The P&L is essential for evaluating operational performance and guiding strategic choices. The cash flow statement reveals how cash moves through a company, vital for assessing liquidity and solvency. It's divided into operating, investing, and financing activities. Positive operating cash flow signals healthy core operations. Persistent negative cash flow, despite profits, is a red flag. Investing activities show capital allocation. Directors should watch for strategic investments or warning signs of poor planning. Financing activities reveal how the company raises and repays capital. Directors use this statement to ensure the company can meet obligations and fund growth. Discrepancies between profit and cash flow often uncover hidden risks. The cash flow statement is indispensable for effective board oversight. Financial ratios are a director's toolkit, a crucial set of instruments for analyzing company health and performance, offering a clear and concise snapshot of the organization's financial standing. Liquidity ratios, like the current ratio, and quick ratios, also known as acid test ratio, measure the ability to meet short-term obligations, ensuring the company can pay its immediate debts. Declining trends warn of cash flow issues, potentially signaling deeper financial distress. Profitability ratios, such as net profit margin, which indicates how much profit a company makes after all expenses. Return on assets, showing how efficiently a company uses its assets to generate earnings. And return on equity, reflecting the return generated for shareholders' investments, reveal how efficiently the company generates profits, providing insights into the effectiveness of its operations. Comparing these to industry benchmarks and also to competitors highlights strengths and weaknesses, offering a clear picture of the company's competitive position. Efficiency ratios like inventory turnover and receivables turnover assess how well assets are managed and how quickly inventory is sold and receivables are collected. Low turnover can signal operational problems such as excess inventory or slow collections. Leverage ratios, including debt to equity, which shows the proportion of debt and equity used to finance a company's assets. And interest coverage, indicating a company's ability to pay interest on its outstanding debt, show how much the company relies on debt and its ability to service it, providing insights into its financial risk. High leverage increases risk. Low interest coverage is a red flag, suggesting potential difficulties in meeting debt obligations. Directors use these ratios to spot trends, benchmark performance against competitors and industry standards, and identify areas needing attention, allowing them to focus on critical issues. Ratios turn raw numbers into actionable insights, transforming complex data into understandable metrics for board discussions, facilitating informed decision-making. Regular ratio analysis helps directors anticipate problems, acting as an early warning system before they escalate, enabling proactive risk management. A strong grasp of these metrics is essential for effective oversight, ensuring directors can fulfill their governance responsibilities. They provide a quick health check and guide deeper investigation, highlighting areas that require further scrutiny. Informed directors use ratios to drive strategic, long-term planning, data-backed decisions, ensuring the company's future success. Understanding core accounting principles is crucial for directors interpreting financial statements. The accrual principle records revenues and expenses when earned, not when cash changes hands, explaining why profit and cash flow can differ. The going concern assumption presumes the company will continue operating, affecting asset values and disclosures. The matching principle ensures expenses are recognized in the same period as related revenues, giving a true picture of performance. Directors must know which accounting standards, Ind AS, IFRS, or US GAAP, the company follows. The principle of conservatism requires caution in recognizing gains and promptness in recording losses, preventing overstatement of assets or profits. Mastery of these principles ensures directors can spot manipulation and uphold reporting integrity. Directors must ensure the integrity and transparency of financial reporting. This means more than just reviewing reports. Active engagement and skepticism are essential. Directors should challenge management's assumptions and scrutinize accounting policies. The Audit Committee, led by financially literate directors, is central to this oversight. Directors must probe discrepancies, especially between profits and cash flow, and investigate complex structures or frequent policy changes. Notes to the financial statements often reveal hidden risks. Never ignore them. Red flags include rising debt, missed forecasts, and large related party transactions. Directors should maintain a mental checklist of warning signs and escalate concerns promptly. Vigilant oversight protects the company and its stakeholders from financial distress and misconduct. The regulatory landscape is evolving. Directors must stay ahead of digital and sustainability reporting requirements. XBRL is now mandatory for financial filings, making data machine-readable and increasing scrutiny. Accuracy is critical. Directors must oversee key e-forms like DPT3, deposits, and GNL1, miscellaneous filings, to ensure compliance. Regulators use real-time alerts to flag anomalies, raising the bar for board vigilance. ESG and BRSR reporting are now essential, requiring rigorous disclosure of environmental, social, and governance metrics. Directors must ensure ESG data is as reliable as financial data investors use it to assess long-term value and risk. Financial oversight now includes digital compliance and sustainability directors must adapt. Staying current with these updates is vital for effective governance and risk mitigation. Let's solidify our understanding by applying these concepts to a practical case scenario. This will allow us to see how these principles work in a real-world context, providing a deeper and more nuanced perspective. Imagine an independent director meticulously reviews financial reports, noting strong profit growth, a seemingly positive sign for the company. However, a closer look reveals a concerning trend: negative operating cash flow, a potential indicator of underlying issues. Further analysis uncovers rising receivables and inventory levels, adding to the complexity of the financial picture. Instead of simply accepting the headline profits at face value, the astute director recognizes the need for deeper investigation. The director probes further, asking crucial questions. Are sales being artificially inflated by risky credit practices? Is inventory piling up due to weakening demand for the company's products? By carefully connecting the dots between the various financial statements, the director begins to paint a more complete and accurate picture. Through this diligent process, the director uncovers hidden liquidity risks that might otherwise have gone unnoticed. This is effective oversight in action, safeguarding the company's financial health. Let's test your knowledge with a sample MCQ. What's the primary purpose of the balance sheet? Answer: it provides a snapshot of a company's assets, liabilities, and equity at a specific point in time. Here's another. If current assets are $500, inventory is $200, and current liabilities are $250, what is the quick ratio? Answer: 1.2. And finally, if net income is reported as high, but operating cash flow is consistently negative, what is a likely cause of this discrepancy? Answer: a significant increase in accounts receivable, suggesting potential issues with collecting payments. Let's discuss some best practices. Always review all financial statements together as an integrated whole, and pay close attention to trends over time. Scrutinize the notes to the financial statements carefully, and don't hesitate to ask probing questions to management. And of course, stay updated on the latest accounting standards and regulatory changes. Directors should benchmark key financial ratios against industry peers, and always maintain a healthy dose of professional skepticism, and never, ever overlook potential red flags or warning signs that something might be amiss. Ultimately, effective oversight means protecting shareholder value and ensuring the long-term sustainable success of the organization. Key takeaways. Remember that the balance sheet provides insights into a company's solvency. The P&L or profit and loss statement reveals its profitability. The cash flow statement sheds light on its liquidity. Financial ratios serve as valuable diagnostic tools, and effective oversight requires you to question everything, leaving no stone unturned. Looking ahead to 2025, be sure to add XBRL reporting and ESG considerations to your compliance checklist. Mastering these essential skills is absolutely non-negotiable for every effective independent director who wants to excel in their role.